We're living through one of the most uncertain financial landscapes in recent memory, where rate hikes, geopolitical tensions, and recession fears dominate the headlines, and investor confidence is hanging by a thread. But here's the thing: chaos doesn't kill innovation. It sharpens it. While much of Wall Street plays defense, a new wave of fintech companies is going on the offensive, quietly leveraging artificial intelligence to redefine how money moves, how credit is assessed, and how financial systems serve the real economy. In today's video, we're diving deep into 3 AI-powered fintech disruptors that are thriving beneath the surface of market noise. These companies are not just reacting to change, they're engineering it. They're using AI to reduce risk, drive efficiency, and expand financial access in ways traditional firms simply can't match. And here's the kicker. Despite strong fundamentals and breakout potential, each of these stocks remains dramatically undervalued, thanks to market-wide pessimism that has blinded many to their quiet momentum. This isn't about chasing hype or betting on moonshots. It's about finding real businesses with real revenue, real technology, and real staying power that are building the financial future with machine learning, automation, and data-driven decision-making at their core. From AI-enhanced credit platforms to re-engineered insurance models and global payment networks, these are the companies poised to lead the next fintech wave. And if you catch them at the right time, the upside could be game-changing. So if you're tired of the noise and looking for smart, forward-thinking plays in a world full of uncertainty, you're in the right place. OPFI Earnings Financial Core. Let's begin with a company that's flying under the radar yet building financial strength where others see only risk. OPFI Inc. While broader markets are gripped by fear and investor sentiment hovers near multi-decade lows, OPFI has remained a standout, proving that even in chaos, opportunity thrives. The company just delivered its 8th consecutive earnings beat, reporting Q4 EPS of $3.03, beating estimates by over 50%. Revenue came in strong at $136 million, 0 cents, and while originations dipped slightly, year-over-year growth is still solidly positive. What sets OPFI apart is its core model. It's not a traditional lender, but a tech-meted platform using AI to evaluate credit risk, streamline approvals, and widen financial access for underserved Americans. This innovation-first approach could prove game-changing, especially as conventional lenders become more conservative. Looking ahead, OPFI expects 2025 adjusted EPS between $1.60 and $1.70, with revenue growth projected between 7% and 13%, a bold outlook in a market full of downgrades. The stock, currently down over 50% from recent highs, may present a rare value opportunity. Even assigning a modest 9.8x forward earnings multiple suggests OPFI could be trading around $11.00, significantly higher than today's levels. With a fintech moat built on AI, OPFI is proving that the smartest innovation often comes during the toughest times. Next up is a lesser-known but fiercely resurgent name. Kingstone Companies Inc., ticker KS. In 2024, while inflation fears and global instability shook the market, Kingstone executed a textbook turnaround that transformed it from a distressed regional insurer into a focused, profitable operator. After years of volatility, the company trimmed exposure in high-risk states like Florida and Texas, repriced policies, and aggressively cut costs. The result? An $18,400,000 0 cents net profit, a 27% return on equity, and a dramatic EPS recovery. Kingstone's transformation wasn't just a lucky rebound, it was strategic. The company unified its tech infrastructure, reduced debt by 25%, and optimized its distribution model using a commission-based remote sales force. These moves have driven direct premiums up 20% yo-yo to $240 million 0 cents, while slashing the net loss ratio from 72.4% to 48.7%. Even with slight misses on expense targets, the overall momentum is undeniable. And while the stock has already surged, pushing its forward price-to-book ratio to 2.35 above the sector median, the depth of its turnaround plus its AI-enhanced risk modeling makes it a compelling case of quality and resilience. In a fearful market, Kingstone is a rare example of silent execution and sector-beating profitability. Finally, we spotlight a Fintech titan that's recently taken a beating, but still holds tremendous upside. Block Inc., ticker S. Following a 25% post-earnings sell-off, the stock has slipped below $60.00, sparking panic among some investors. But beneath the surface lies a company with strong fundamentals, robust growth potential, and cutting-edge AI fintech applications ready to scale. Yes, Block missed earnings and revenue last quarter, but macro headwinds, including rising rates and tech sector volatility, have punished even well-performing companies. Still, Block posted 14% yo-yo growth in gross profit, with $1,380,000,000 from Cash App and $924,000,000 from Square. International expansion is booming, with Square's gross payment volume up 25%, yo-yo overseas, and Cash App Borrow, now FDIC approved, introduces fresh monetization channels through AI-driven underwriting. Perhaps most compelling is Block's valuation, trading at just 12.3x forward EPS, with 32% projected earnings growth this fiscal year. That gives Block a remarkably low PEG ratio for a company of its scale and innovation. In a market hungry for solid ground, Block offers a rare trifecta: discounted entry, global traction, and long-term AI-powered growth. This isn't just a recovery play, it's a strategic bet on the future of digital finance.